welcome to the final class for ARM 56. This is our course review. We've actually gone, well, we're kind of cheating since we kind of ended a little early as far as, but we're at week 10 basically, and we followed the week 9 basically yesterday and covering chapter 11. So for tonight's class, the intent of this is to really help for those from a testing, from like a test prep, and to help with test taking strategy. So for many people that are either online now or that will be listening to the recording, many people have already taken the ARM 54 or 55, so this part will be review. But for those that are starting with 56, here's some test prep strategy that you want to certainly consider, especially for those that haven't taken a test in a long time, and then let alone it's a computer-based test. It can be a little intimidating for many folks. So as we go through, tonight you'll kind of see what areas you should be emphasizing as far as your study time, but then also just again from a strategy standpoint. So the ARM exam is 75 questions, and you have 2 hours to complete the exam. As far as setting up or ordering the exam, you have to do that through the institutes. So it's www.theinstitutes.org, and once on the site, you'll select exam. And then the exam you want to take would be ARM 56 in this case, and then it'll basically prompt you through there as far as your testing window. People usually ask when they go on there, you'll notice that it says ARM 56A, or Segment A, Segment B, Segment C, and Segment D. The reason why they do that is they started breaking up the exam into different, so you can do like Segment A is chapters 1 through 3, and then Segment B would be 4 through 6. I personally don't recommend doing the segmented exams. I think one of the advantages of doing it at the whole exam is that you'll find that the questions throughout, maybe a question later on in the exam will actually help make you remember a question that you weren't so sure about at the very beginning. And so there might be clues in other questions that will certainly help you out. So with 75 questions, in order to pass the exam, it's 70% or higher is passing. So I always try to do the math. That means you can miss 22 questions and still pass the exam. While of course the goal is to get as much information, and make this useful for a class, but ultimately the goal for everyone, most likely, is to be able to pass the exam. So from a strategy standpoint, what I recommend is that if you don't know a question, you'll have the ability to mark questions when it's computer-based as you go through that you want to review later. And if there's questions you're not sure about, I'd go ahead and just mark those. And if they're not answered, you certainly want to mark those as well. And what I typically do is start kind of ticking questions that I have pretty sure that I have no idea whether it's right or wrong. And that'll kind of give you a clue of whether you probably passed the exam or not, of where you're going to go. Unlike the SAT or other exams, you do want to answer every single question. You're not penalized for answering a question wrong. So certainly answer each of the questions. So considering that there's 75 questions and you have 2 hours, that means you got a little bit over a minute, about a minute and 15 seconds to answer each of the questions. You'll find some are fairly straightforward and you'll be able to answer them pretty easily, and others are going to require a little more time. On most exams, whether it be 55, 56, or 54 for that matter, about 53 questions will be simple or core questions, meaning they're asking about a definition, or it's just going to be based upon that individual question. Then there's going to be what we call applied questions. And so an applied question is going to be more based on a scenario. They're going to provide you information about a ABC company is doing such and such, and give you some background, and it might be about 2 or 3 paragraphs worth of information in there. And then based upon that, they're going to ask 3 or 4 questions based upon that scenario. The questions don't build upon each other, so that's good. They basically stand alone, but you want to make sure that you read the questions fairly carefully when you do that. So going to my next bullet there is read each question very carefully. Don't rush your understanding. What I find that many people do is they misread a question, because when I show a little bit later, I'm going to show some sample questions that are from the Care Guide. And you can easily, by all these are true except for, or which one of these is, is not. It's almost like reverse worded type question. So you want to make sure you take the time to read the questions very carefully to make sure that you really understand what they are asking. So answer the questions you know. Obviously that makes sense. Do those first. Mark the questions that you're not 100% correct. Mark the questions you skip. A lot of times you can eliminate wrong answers to a 50-50 chance, and I believe even on the online you can kind of, there's a little thing you can do to say, okay, this is not one of those, so you can eliminate questions on the screen. Now, and that's what you're typically going to find is that either it's going to be pretty obvious, or you're going to be, there'll be a question. I'll give an example tonight, which it looks pretty close. It's kind of, it might be more 50-50. But you definitely want to try to reduce your choices there. Again, answer every question, and usually your first choice is usually the correct answer. What I typically find is people overanalyze the question and trying to think, are they really trying to ask this, and try to dig too deep. So don't overanalyze, and usually your first instinct, based upon what you've been reading, is usually going to be the correct one. As far as you're studying, what I typically recommend, this is what I also recommended at the very beginning, is when you start with each chapter, now that you've gone through the whole thing, now you're going to go back, read the Direct Your Learning in the very beginning. What are the objectives? So you want to start with that. What are the key learning objectives? And make flashcards of those topics that ask you to list anything. So if, what are the 5, or what are the advantages or disadvantages of, doing a captive? I would make lists on those. And so anything that's bullet pointed, typically in the textbook, that's probably something you want to make a flashcard for. In some cases, I would say definitions as well. Next, I would then read the chapter summary. If that same information they're talking about is repeated in the very back in the summary, it's likely important enough for the test. So you found it in 2 places, and then the middle is going to be the 3rd place. And then review those elements that you're not familiar. So, and the big thing that I really try to encourage people, especially in this course, is to understand the why. It's one thing, the people that have called or emailed me and said they failed, one of the reasons why is they just tried to memorize everything. And if you don't, you should be able to, hopefully after going through this the last 10 weeks, is, well, understand why would you want to do a captive? Why would you want to do a retro insurance program? Why would you want to do a self-insurance? What are the advantages? And what type of entity would be best suited for, doing catastrophe bonds or things like that. So if you understand the why, you're going to be able to answer the questions much better. And so that kind of goes back to that, like the big picture, the 50,000-foot level. If you understand that, you'll do much better on the exam. And again, make flashcards of keywords and phrases as well. On the applied questions, they address several chapters based upon the scenario. So when I mentioned that you're going to have like 3 paragraphs of probably text that they're going to want you to read, when you do that, what you're going to find in there is they're going to ask questions that deal with probably maybe captive, one with self-insurance, maybe one with what the rates should be, or cost allocation. So you're going to find in the scenarios, they're going to, based upon that information, they're going to ask questions that go throughout the entire textbook. And the other key point I'd like to mention, because people stress usually maybe, most likely the chapter that people are going to stress about is chapter 10, which is the derivatives, insurance-linked securities, and 9 and 10 are really those 2 chapters. The good news, you can fail an entire chapter of questions and still pass the exam. If you consider that we have 11 chapters, and some chapters like chapter 9 are fairly small, you're probably looking at maybe 6 or 7 questions per chapter. You go back to the 22, how many questions are you going to get? And then some of the questions are going to be very easy, and then some are obviously going to be pretty hard. And so what I try to show is, you can still fail, an entire chapter and still pass. So here's an example from 54 of what the grade report will look like. So I guess I should back up, is when you're doing the computer-based exam, you'll be taking the test, and at the very end, you're going to have that you hit the submit button. And after the submit, it's going to say, do you want to take a survey about your experience taking the test? So if you do that, you've wasted another minute or so doing that. And then after that, you click the button that you're ready to see your grades. If you decide to skip the survey, then it goes right to the exam report. And so you can hold your breath for about 2 seconds, and then it's either going to say, that you passed or not, or you didn't pass. Is basically what happens. The report you're seeing on the screen is what you're going to receive about a week later, and it's going to be showing how you performed on each of the individual chapters. So hopefully everyone will pass, and you won't have to worry about restudying a different chapter. But the point that I want to show here is that if you notice, for 54, the hardest chapters are typically 6 and 10. And so even though this person did great, 100% pretty much almost on all the other sections, not doing about 50% or missing half the questions almost on those other chapters, and they're able to still pass. And just so you know, a good score, it's not just pass, it's good, means they probably scored in the 90% or 80, high 85 and above is what that score basically means. So that kind of gives you an idea of what that might look like there. So having gone through that piece as far as kind of the test-taking strategy, let's go and jump right into the actual chapters and what things that you're going to want to focus on. So the way I've designed this review is not to go rehash everything that we've gone through, but to kind of, what are the key elements that you want to focus on? And that when I talk about key elements, most likely these are the things that I would expect, or at least my past experience has shown, that you're going to have questions on. Or at least you need to have a pretty good understanding because they're foundational and they may build upon other sections of it. So on the introduction to risk financing, the basic elements of what is risk financing. It's insurance, or risk transfers, excuse me, insurance, contract, and hedging, okay, are really the 3 forms of risk transfer. And I'm going to show you a sample question that kind of deals with, about this, even the fundamentals, what you might consider a basic question. When we talk about risk retention, okay, so risk retention within there you have a couple different choices. You have planned versus unplanned. And if you remember back, planned retention means that you're actually developing a self-insured program, whereas an unplanned is you're not setting aside. You may know about it. It might be small stuff. Like someone a supermarket, someone has foodborne illness, and they claim, and you say, okay, here's a $10 gift certificate. There's not really a structure. There's no program for it. You're just kind of, and so that would be something like an unplanned. Partial versus a full retention. The idea is when you're going to retain risk and self-insured, that you're either going to fund your retention, or are you going to do insurance, or actually that's how I went funded, I jumped there. The partial versus full retention, most organizations are going to be partial. Rarely do you do a full retention. So the idea that you're going to self-insure to the maximum would be a full retention, whereas partial means you're going to do maybe self-insured retention to 100,000 or 1 million, and then you're going to buy excess insurance after that. So then you're going to be transferring, and so that's where the retention comes from. On the funded versus unfunded is, are you going to keep reserves? Are you kind of an unfunded, we've been more of a pay-as-you-go system, whereas a funded reserve is you're basically making sure you're tracking your liabilities and what monies you're going to need to pay for future claims. So you want to make sure from risk retention you understand the key components of what what a risk retention program might look like. Risk financing goals, I should have probably marked this one red. You want to make sure that you do understand the risk financing goals. Most likely you will see some type of question on there. The idea being, when you think about risk financing, why do we have insurance in the first place? And so these are the 5 key points of why you would want to have some type of risk financing plan and what you're trying to achieve. And ultimately the first one is, pay for a negative consequence of an event. Something bad happens, a hurricane, or a theft, you want to be able to pay for that and have money to do that. The maintaining liquidity portion of it is the idea that when you buy insurance, you're basically you're paying a certain amount so you can have liquid. So you're not holding all these monies and reserves and not be able to use those. So that's the idea of liquidity, is that it allows you to sleep at night as well. And on that. And then manage uncertainty, which makes sense. That goes to the sleeping at night. Comply with legal and regulatory requirements. So if you're required to maintain workers' comp coverage, you can comply with that. That will be a goal. And then finally, minimize the total cost of risk is going to also be one of the goals by risk financing, is you want to try to do it as cheaply as possible, or as inexpensive as possible. So as I mentioned in the beginning of the course, one of the things that is important is to be able to understand what the different charts mean. And so in this case, when we take a look at what is risk financing, and we see, from a risk treatment standpoint, how we can treat those risk treatment techniques. Well, all the techniques we have listed here, but when we talk about risk financing, that is a certain type of technique which breaks out into transfer the risk or retain the risk. And so when we transfer the risk, that's when we talk about the hedging and the contractual risk transfer and those types of things. And then retaining the risk would be self-insurance. And really, retaining the risk is really the only thing that self-insurance, there's not really any other names for it. And so most likely you will have a question dealing asking about transferring what this called as self-insurance, and you'll have a question saying, what type of technique is this of self-insurance? Well, if the answer is transfer the risk, you're wrong. It's going to be retaining the risk. Okay? And then what you're also going to want to make sure when you look at these charts is the idea of selecting a risk financing plan. Throughout the text, you saw the same type of triangle, and the captive and the retro and the different types of chapters where this was discussed. And you want to be able to explain at what point, what type of program would you, what would you have? So on the bottom one, the low severity. So low severity, high, and then we would probably say low severity, high frequency types of claims. So this is loss frequencies down here. So if we have low severity but they happen a lot, that's something we're going to want to self-insure. Whereas if we have somebody that's a high severity and also it's a high frequency type of event, you might want to consider whether you even want to do that. That is something that if you know that you're going to have severe losses, you really want to avoid the risk in the first place. But if you have something that would be a low frequency but a high severity, that's really what catastrophic insurance would be for. It's going to be really for those events, and you're really going to insure really everything in these layers. So you want to understand, low to medium severity is probably the retro insurance programs would be in there. Self-insured would be in this. Captive would probably be in this category. But typically your high severity events are really, you want to transfer your high severity, low frequency events. That the rare events are those things that you're typically going to pass on to someone else. And then also this kind of basically goes what I was talking about. You want to, and this is, if you understand the Prouty approach, is that when you have, it's definitely going to occur and it's severe, that was that top triangle we talked about, that's when you want to avoid it, okay? And then, talked about transfer, retain, when you want to do these things. And again, transfer almost never happens, but severe, you typically will want to transfer at that point. And then the final thing in Chapter 1 that you want to make sure is that because ERM is fairly new, at least as far as the textbook goes, there will most likely be a question saying, okay, how does ERM work from a risk financing standpoint, or how does it differ? And so this is near the back of the textbook, in the back of Chapter 1 near the end. And so they'll typically, I would expect that you would have a question dealing with this area, since this is something that it would be a new area that they're starting to focus more on. All right, moving to Chapter 2. So under Chapter 2, the focus was estimating hazard risk. So this was probably more of the challenge, because there's actually dealing with calculations or knowing what the steps are. And so the main focus that I would go on here is really to understand loss development factors and loss development triangles. And so in the textbook, they have some examples, but if you understand why loss development is important, what happens to loss development over a period of time, and how you would use that to do some calculations, and also, I would definitely, this is probably the hardest chapter. I would probably review this chapter of any of them, just because there's a lot of techniques, and this is really, I would say, foundational to understanding this is what the actuaries do for you, and so it's important to understand this part. The next area is the increased limit factor three-step process. And then the next part is the forecasting probable variation from expected losses using three types of probability distributions. So between these two, I mean, I can't spend too much time on really focusing on rehashing the entire chapter 2, but this is the one that I would study the most. And then when you focus on the three-step process, again, it's a list. So if they ask, what are the three-step process? Calculating increased limit factors, calculating the increased limit factor for specific layer of losses, and then forecasting losses at various loss limits is what the three-step process is. And then on the forecasting for variations, if you remember, we took a look at, we said, okay, well, there's a frequency probability distribution and then a severity and the total loss probability. And the total loss really is the combination of those two. So it's just how those things are used. It's not necessarily doing the calculations as much as it is really understanding how you estimate hazard risk as part of it. So this is the, on the one part, the one area that, again, if you can, if the area to memorize, again, 4 steps. It talks about steps, bullets, whatever you want to call it. The 4 steps in loss forecasting: collect and organize the past data, limit individual losses. And when you think about why do what's the why? Why do you limit individual losses? So there'll be a question probably on why would you do that? And again, the idea being that you need to kind of smooth out the data. Your outliers, you don't want something to skew your data so much, so you're going to have to limit individual losses. And typically they might be limited to the self-insured retention level, and this helps from the estimating factor. Apply loss development and trend factors to the data, and then finally you're going to forecast your losses. So this whole area is the area that I would focus on in the most, again, for Chapter 2. And as far as doing the math piece of it, that's usually not the, as far as doing the calculations. If anything, it's going to be fairly simple calculations. They're going to give it to you. If there's any formulas that are in here, they'll provide the formulas that you need to do the calculations. So Chapter 3, moving on there, under Chapter 3, we focused on transferring hazard risk through insurance. And what this started about when we went through Chapter 3 is the first discussion was on pooling and how does pooling work? Because ultimately that's what insurance is. It's getting people together and to create a cooperative. So you need to understand risk pooling, how it's the basis for insurance programs, of that the more people you have, the law of large numbers, those type of concepts are really going to be the concepts that you want to make sure you remember there. And then also within the insurance, when you transfer, that there's different types of deductible programs, the per claim deductible or the per accident or per occurrence. And what I would think about when you to help remember this is on your auto coverage, you have typically a per claim and per occurrence deductible, or what's going to be paid out, I should say, not necessarily deductible, but it's what they're going to pay up to. 100,000, 300 limit means 100,000 per claim and up to 300,000 per occurrence. So the max that they'll pay would be the aggregate of the 300,000, and you need to also understand the different types. On there. I think from the insurance standpoint, this might hopefully be one of the easier chapters there. You want to make sure you understand the benefits of insurance. The textbook, if you look at it, it's always advantages, disadvantages. They talk about that throughout the textbook. And so typically, the benefits, they usually break it out, and I think if I remember correctly in the beginning, they talk, well, what are the benefits to the individual and what are the benefits to society? So you'll most likely have a question about, well, what's the benefit to society by having insurance? And the idea behind there is, if individually, obviously, I would benefit because I can stay in business, but it's from a societal benefit is if you think about Hurricane Sandy or the other events, that there's coverage that that as a collective. That people can regroup. So that would be a benefit, one of the benefits of society. And also there's the aspect that it's going to benefit from productive use of resources and things like that. That's some of the discussions that were talked about that. And then the last one really is the insurance helps to reduce the burden to society of uncompensated accident victims. So if you think about workers' comp, or in California and many other states, you have no fault in auto insurance. That typically that if there's an accident victim, the idea is that there's going to be compensation through the insurance program. Probably and this is again foundational, the ideally insurable loss exposure. You'll want to make sure this is probably the one that you do want to memorize, and if you think about it, makes common sense. This is what insurance companies would want to characterize as kind of the perfect risk. It's a loss exposure that involves pure, not speculative risk. Speculative meaning that there can be gain typically in the activity. With a pure risk, it's either the accident happens or it doesn't happen. So that's pure risk. Loss exposure is subject to accidental loss from the insured standpoint. So that it's not going to be, and when we talk about accidental, it's not going to be done on purpose. Someone slipping and falling and things like that, those are accidental. That there can be some type of trending data, from that. The loss of exposure is subject to losses that are definite in time and that are measurable. So the idea that a car accident happens, okay, it happened at 3:22 in the afternoon at such and such intersection, and it did $10,000 in damages. That's measurable. We know the cost. We know the time frame from a policy standpoint. It's when you get to things that are, why asbestos and other things are a little bit harder, because when did the exposure occur? How much damage did it cause? Were there other contributing factors? Do we know that it was actually caused by the employee's work? Was it done something at home? And so that gives you an idea about the definite time and measurable. Loss exposure is one of a large number of similar but independent exposures. Again, from a homeowner's insurance standpoint, that it's a large number, that things aren't correlated or tied together. We want these things to be separated. So auto accidents occur all over the place in the state, but there's no relationship. Each one's independent. It's not a chain reaction that's causing them. Loss exposure is not subject to a loss that would simultaneously affect many other similar loss exposures. Loss would not be catastrophic. So that's why you have from California Earthquake Authority, those type of things. For those things are FEMA with flood insurance. Insurance companies don't want to write coverage because they're catastrophic and they would simultaneously affect many others. So therefore, it's not really a good insurable risk from that standpoint. And then finally, loss exposure is economically feasible to insure. And that kind of goes to TRIA and some others. It really goes to the catastrophic, that it doesn't, does it make sense to insure some of these catastrophic losses? And that's where, again, the reinsurance market really kicks in for those things. And also on this chapter, the excess liability versus the umbrella policy. What you really want to know for this section is really how layering works. And know that umbrella really, as the name implies, covers more exposures. But on these next couple charts that you see in here is to really, if you had a graph and they provided this, to understand that you have these primary layers, these other things would kick in at certain points, and to kind of know that 5x of 1 or those type of things. How do those policies actually work, and what do they represent? So understanding how policies are layered will be a key component of the exam. Chapter 4, moving on now. So if you think about how we kind of talked about, with chapter, the prior chapter here is, transferring hazard risk through insurance and talking about pooling. And then as we move to self-insurance, now we start moving on to the different types of programs. So self-insurance, the idea of formal versus informal retention, meaning that when we self-insure, that we actually have a program, we have a TPA, we have things in place, reserves. That would be a formal retention that we're doing it, whereas an informal is it's just something that's unexpected, that we're going to have to deal with it, but we haven't recognized that as a line of coverage maybe or something emerging. So understand exposures that self-insurance is most appropriate. And so if going back to the original kind of triangle that we looked at, it's losses that are frequent, but they're of low severity typically, and maybe medium severity in some cases. But you want to understand that typically, what is the best? So workers' comp, auto, those type of things make sense to insure because there's somewhat of predictive nature of what we'd be able to see, or regression analysis will help us in that. And then finally, you want to make sure you understand the advantages versus the disadvantages of self-insurance, and what does that mean? In the back, one of the disadvantages is the tax implications that and usually the questions that you're going to see are going to be tax related or accounting related on the exam, because the reality is that from a risk management standpoint, that's money that you're paying someone else when you do taxes. And so what most organizations try to do is avoid paying taxes as much as they can, and so that's got to be one of the considerations. And so that's typically why there's usually a question like that on the exam. And then moving on, once we get to Chapter 5, we start looking at retrospective rating plans. And when we look at that, we want to understand the operation and when it would be most appropriate to use. And so typically under retrospective, it's going to be more to low to medium type of risks. That would be, again, on the severity or the frequency side, maybe medium to frequent on there. The two types of plans, incurred loss retro and then a paid loss retro. And if you remember back from the class, what we looked at is that the difference between an incurred loss is that when you have incurred, that's what's been paid and also reserved. And so you're paying for what the estimate of that claim is going to be, whereas a paid loss, it's actually when those payments are made. And if when claims get paid, it's usually later. So it's going to take longer for the payments to be made. And the concerns, for those that are doing retro, they're going to want some type of security or some credit to make sure that the organization that's doing the retro is financially stable to be able to do a paid loss. So, again, if you think about what a retro plan does, it allows someone that's can't do self-insurance yet. It's kind of the baby step from a regular insurance program to go into a retro to where they get some of the benefits of a self-insured program, and by basically, if they have reduced their injuries and they have a better claim history, they're going to reap the benefits much sooner compared to just a regular insurance program. And you'll want to make sure you understand like the low limits, the high, and you'll see that in a minute of kind of the calculations that need to be part of that. And then the steps. So of selecting a plan, determine which coverages to include in the plan, the limit to which the plan will apply, the loss limitations, and also the max and minimum premiums are really the four steps that are part of selecting a program, and we'll go through some of those. So in this chapter, they do say you do need to actually know the formula. So this is where you actually will be asked to do a calculation. So if you look in the very beginning of each of the chapters on the objectives, most of the same things say explain, be able to understand. This one actually does say calculate or be able to do calculations. So when it does say that, that means you do need to know how to do the calculations. They typically, at least on when we do net present value and all that, they provide the formulas. There should be a formula tab, but you need to understand how to use it and what the various elements are. So this is the rating plan. So you need to understand for retro plans what's considered basic premium, converted losses, loss premium, the tax multiplier, how experience modifications work. So you want to make sure that you do understand this portion for the retro program. So we move on from retros to reinsurance now. On the reinsurance, I think obviously wasn't that long ago we went over this chapter, but why, I think the main question that you want to have is why do we have reinsurance? So, which goes to the first bullet, which is the functions. Increases large line capacity, provides catastrophe protection, stabilizes loss experience, surplus relief, and facilitate withdrawal from market. So you want to know why we would have reinsurance. What's the purpose of it? And again, if you go back to the discussions, and as we go through this tonight, and I encourage everyone to also revisit the different chapters if they're having listening to the recordings and go back over some of these. But this will help really reinforce those ideas. The three sources, usually there'll be a question, at least in the past there was, about where you would buy reinsurance from or what were the providers. So you have the professional reinsurers, the departments or primary insurers, and the reinsurance pools, syndicates, and associations. Typically, like I said, there's usually at least one question that talks about what it'll describe the type of organization, and then you'll have to pick from that and say, okay, which one, what does this describe? Which one of these type of, is it a professional reinsurer or is it a, primary? And then also, the other thing that I put on here as far as a bullet that you want to focus on is the types of there's different types of reinsurance, and the one that you want to probably spend the most time or really understand is excess of loss reinsurance. I think I have the chart on the next page here, but when you understand, excess of loss is the most common, where the primary insurers indemnify for losses that exceed the specified dollar amount. And then once you have the excess of loss reinsurance, you're going to have different types. You have a per loss of excess, catastrophe excess of loss per policy. And these are the things we talked about in class, where a per risk is going to be based upon that specific line, what actually happened. That catastrophe is going to be based upon, it's specific to, it's saying we're only going to cover those losses that deal with hurricanes or earthquakes. The aggregate, once you exceed a certain point, that it's like a stop loss. So you just want to make sure you understand the different types. And a lot of these terms you'll find that are they're really used even the captives, all these different terms of aggregate, per excess, per policy areas. On the reinsurance, what we talked about is the treaty versus the facultative. And when we talk about excess of loss on here, so this is the treaty is going to be the more common type, and then the excess of loss. Then we have the types, the per risk policy, per occurrence, and aggregate. The pro rata on the treaty is where we talked about where the reinsurer is going to kind of reap some of the benefits of the policy being sold, and so there's a little skin in the game for the primary insurance organization as well as the reinsurer based upon the type of coverage that's going to be written there. And then moving on to the captive insurance. So the type of captive insurance programs, you want to know the difference between the different types of insurance programs, whether it be single parent, group. And so you're going to be most likely provided a question that says, this is describes whatever organization, and say, which kind of captive is this? So that's typically how those questions are going to work. You want to make sure you understand the advantages, disadvantages of forming a captive, and just in general of what that means. And then the other thing we talked about was fronting company versus direct writing captive. And so, just if you remember correctly, for a fronting company as a captive, one of the disadvantages that we want to talk about is that you'd be admitted or not admitted. So if you're in another state, you're not admitted, which means you don't fall under the insurance regulations of that state, which also means you can't write coverage in that state to others besides yourself. In order to do that, you need to either get a fronting company, which basically is another insurance company that will write the paper for you, that they will sell the policy through them, and they basically, it's really a pass-through. And for doing that, they charge 20% or 10% of whatever premium that's collected. So that's their reason for wanting to do that. Or you could be a direct writing captive, which basically means that you would be admitted in that particular state to actually write coverage, and that means you can write insurance coverage to third parties, to other organizations. So you want to make sure you know the difference between those. And then I put on here the considerations in setting up a captive. these are probably the, there's other considerations they had in there, but I would say these are probably the bigger ones, at least in my book, even though under other areas, is what coverages, workers' comp, GL, personal liability, employment practices liability, what premiums, how are you going to set up, as it can be retrospective, guaranteed cost, where you're going to domicile, that location. Based upon where you domicile is also what kind of coverages you may be able to write. The resources of the parent organization, the financial accounting issues, those are the things you'll probably typically see some questions as it relates to some of the captive type questions on there. Move on to contractual risk transfer, Chapter 8. We want to make sure under this chapter you know the different types of contractual transfers. In the very beginning, the list that we have on there. But notice I did highlight waivers and hold harmless agreements. If anything where you're going to probably get questions, it's going to be on the waivers and hold harmless agreements, and possibly the disclaimer warranties area or limitations liability are probably the three. And the reason why waivers and hold harmless agreements is because they're so common. We see them actually every day, and so you want to make sure you understand what the limitations of those are, and what does that mean when you have a hold harmless agreement? What does it actually do? You're most likely also going to see a question on additionally insured and named insured endorsements. What is not so much what is the difference, but why would you want to have additionally insured? What are the benefits of being additionally insured? And that it's one thing just to say that you want to be listed as or you want a certificate of insurance and be listed on the certificate. That as I talked about in the class, that does nothing. You actually want to have the additionally insured endorsement so that within the policy you're actually listed as someone that would need to be covered in the event of an event. And then the common law liabilities. There's a small section on some of the common law liabilities, meaning that within the states there's certain things that you can't transfer. And it kind of goes really to the statutory limitations as well when you talk about common law, because these are things that have been settled through the courts, is the wording of the limitations, and I put gross negligence down there. So one of the things that you can't transfer is gross negligence. And so what used to happen is that there were some policies at one point that said they included gross negligence there, and that went to the courts, and the court said, hey, if your employee is grossly negligent, you can't transfer to someone else and say, okay, we're going to wash our hands of it, and you're not responsible for that injury by being gross. So you'll see almost all waivers now just say negligence. They don't say gross for that very reason because of the courts. On the surety, most likely you'll probably get a question here, and it's mainly just because of the language being used of who's responsible for the payment. And we talked about this during the class that the arrows were kind of going in the wrong direction, or how they described it was correct in the textbook. But as far as how who gets paid what in the event of non-performance, basically, and so if performance is not kept, basically the money will go back to the obligee. The promise to perform is also to the obligee. The surety payment, the bond premium, the principal will pay the premium to get the surety, but then also the surety is what's going to guarantee performance as part of that. Chapter 9. We talked about transferred financial risk. So this is when we started talking about derivatives and securitization. The key elements here that you're going to want to focus on are the categories of financial risk, which are market risk, credit risk, and price risk. And if you remember, since it was only a couple weeks ago, that within there, when you talk about credit risk, well, what's that? Well, that's the ability. Are people going to pay you back? You extended them credit, are going to pay you back. Market risk has to do with inflation. Trying to think of the other terms there. I just went blank, but you want to make sure that on those you want to understand the three elements on there. The derivatives. So within there, then the other elements, as far as transient financial risk, you have derivatives, which are forwards and futures contracts and how are they used, and they're really used for hedging, and so that's the element to use there. And then finally on securitization, you just want to have a general understanding of what securitization is, which is basically you're taking something that has a certain value and you're kind of, you're monetizing an asset and trying to sell it. And so this is that general overview that organization, whether it be a bank, insurer, that they're going to have an income-producing asset, they put it in the special purpose vehicle, and then they sell these securities to investors, and they get cash, and the cash goes back out. And that kind of, again, looking at the mortgages, things like that, that's how those items were basically securitized. So this Chapter 9 is actually the shortest chapter because it really builds upon which is in Chapter 10, as we talk about here, which is really more into using some of those things to transfer hazard risk to capital markets. On the focus on here, you want to understand the types of products. When we talk about capital markets, you want to know how they work and advantages and disadvantages of each. So insurance-linked securities, when we talk about that, we're really talking about catastrophe bonds. And I sent out, I think there's also, I put up on the website, are links to some articles that talked about the catastrophe bonds. And so there was actually, I read an article, I'll see if I can send out, that talked about that the market for Australian catastrophe bonds, I think for, I don't know if it's hurricanes, but it was some natural disaster, that the market's really good now for investors to go buy these catastrophe bonds of whether they're going to have. And so, so insurance-linked securities are going to be really, the main component of those are catastrophe bonds. We talk about insurance derivatives, we're talking about swaps and insurance options, and really the focus would be on insurance options more than anything else that I would spend the time on. And then finally, on the third type of capital market product would be continued capital arrangements, which I basically defined the three that are the most common: standby credit facility, the contingent surplus note, and the catastrophe equity put option are really the three that you would most likely see. And you just want to have an understanding that what are they? You're not going to have to do any calculations, but you want to understand if they give you a scenario, saying, well, they're looking at alternative risk financing, what would be an option for this type of scenario? That's the type of question you may see on there. And then the last thing on there is basic understanding of regulatory and accounting issues. The idea being that is this insurance or is these securities? Who are they regulated by? What's the accounting principles? And what I guess I'd probably throw out that reminder again is that the focus of the textbook is that you're not going to be an expert in all these things. The focus is on, as a risk manager, that may be approached, or if a broker comes to you and says, hey, we've got this, to have a basic understanding of what are the risks associated with doing this. Is it a good, is it a good investment for the organization? Some organizations, it might be a good way to go, but you want to make sure you understand, how capital markets would certainly work in that regard. And then finally, based upon what we talked about last night in the last class, was allocating costs of managing risks. And so the main focus here, as we talked about, cost allocation system, should focus on risk management costs, retain losses, insurance premiums, risk control activities, administrative expenses. What are its purposes? And this is probably the area that I would focus on. What you're trying to facilitate by having a allocation program, risk bearing versus risk sharing. Again, allocating to department versus socializing some of the programs, and some of the costs that can be allocated as part of that. So cost of accidental losses that are not reimbursed by insurance or other outside sources, insurance premiums, and cost of risk. So you kind of go through, and as we go through this all in one night, you're going, oh my gosh, how am I going to study for all this stuff? This is, But if you think about it, it's been a progression that we've actually gone through, and what step, if you kind of think about how insurance works, how do you set deductibles, then you go to insurance, self-insured, retro, form a captive. It's really a progression of how an organization might look at these things, and then also some of the contractual risk transfer issues that are part of that. Then the other part, this is probably the key part on Chapter 11, is to understand the exposure versus experience-based models. Understand that experience-based is more volatile, but it has more of a direct impact, and usually most use a blended system. You know, if you remember when we went through the charts the other night on there, one of the things that we looked at is that 80% was exposure and 20% was experience. But even only 20%, it had a huge impact on the cost, just by because the experience really does have an impact. And so even though it might be a small percentage of it, it certainly it shows the volatility that if you did purely experience-based, it would be detrimental in some cases. You'd just be up and down depending on the year. And so that's why you want to do exposure and experience-based as the model. And then lastly, the consideration when implementing from an accounting system. As we talked about claim cost allocation system, the challenges you're going to have is you need to make sure that your accounting system can even do it, because will take a significant administrative support to work out the formulas. How it's going to the tax system for the organization's operations, how that would have an impact, and then finally risk management information system. You know, to make sure that those systems will talk to the accounting system will certainly be part of that as well. So we went through quite a bit. I know that there's probably some questions and how we can go through. So one of the first questions is, since I've overwhelmed everyone, is if you have questions after we go through the school course, can you email me or call me? Absolutely. Feel free to do that. I'm more than happy to answer the questions and walk through those various elements as part of that. Now, one of the things I do want to do as we kind of wait for more questions to come in is I want to go ahead and show a couple, I guess, some examples from the KIR guide to kind of give you an idea of what you might expect for types of questions. So hopefully this is showing on the screen here. Okay. All right, still showing there. And then, okay, there we go. Sorry for that interruption there. So here's some sample questions, and this is from the old KIR guide from the ARM 56. See if I can make this just a little bit larger for folks. And so one of the questions that I picked from here. So we'll do the bottom question, which is question 4 here. What of the following is not an example of risk financing technique of transfer? So we'll give a chance for people to look at that, and I'll go ahead and answer some of those other questions here. So again, which of the following is not an example of risk financing technique of transfer? So for those in the for those in there, which is it? Okay. So the answer in this case is going to be question 4 is A. Okay. And what I like about the KIR guide, and so I'm kind of doing a little advertisement for it on here, but you know, it'll actually compare to the institutes where they just say, here's the answer, and look it up on page such and such. They don't tell you why. So the KIR guide gives a little why answer. It says indemnification or hold harmless agreements, insurance policies, and hedging are all examples of risk transfer techniques. As it names it suggests, a self-insured retention is a cost of loss which is borne by the injured party. So when you look at this, a self-insured retention, and the key word here is the technique of transfer. Okay, so that's why when you look at those, a lot of times I will focus on risk financing technique and then get the word transfer in there. Okay, and so obviously insurance policy, that's transferring, hedging is a future, that's transfer, indemnification, hold harm, that's contractual risk transfer. So the only thing that in this case would be the self-insured retention on that one. So that gives a little example on there. Another question came in earlier. So how long you have access to the recordings? For the rest of your life. As long as the website's up, you'll have access to the recordings now that you signed up for the course, and so those will be available for you, and I'll keep those posted, and so you can watch them at all hours of the day and night on there. So I'm going to go through. I'll select a couple other questions here. So here's question 6. We'll use it. The nice thing is also tells you the text number, but the text is the old text, so that's the other reason why I don't have can't well, they show the new one, I don't have that. So which of the following is not a risk financing goal? So A, paying for losses. B, maintaining an appropriate level of liquidity. C, managing the uncertainty of loss outcomes. Or D, increasing the possibility of gain from investments. Okay. So just give a couple seconds for people to kind of think about that. So the next one, so that question, so number 6 of the question, the answer is D. And the reason for that, when you look at that, if you think about risk financing goal, we want to pay for losses. Appropriate level of liquidity, that's one of the things we talked about, is you want, it helps you keep your money to use it for other things. So you're liquid and not having to hold a high amount of reserves, and also manages the uncertainty of loss outcomes. Increasing the possibility of gain from investments, that's a speculative risk. And that's not really something, that's not the purpose of risk financing, is increasing the possibility of gain on there. So we do have a question. Okay. Give me an answer there. All right. So let's go ahead. I'm going to try to do a different chapter, see if I can scan through here. So we're going to do retrospective question here. So just give me a moment to. And actually, yeah, we'll go through. Because some of these questions are out of order, so I actually kind of put them in there. So apologize for making people dizzy. They're online as they're waiting for this, but all right. So we'll go to the first one. Is the first question on the right on retrospective rating plans. Retrospective rating plans are best suited for business firms having which of the following types of losses? A, high frequency, high severity losses. B, low frequency, low severity losses. C, medium to low frequency, high severity losses. Or D, low to medium severity, high frequency losses. Okay, this is where you have to watch the wording. So on this one, actually, the answer is actually going to be D on this one. Okay, and if you look at all the answers, and this is one of the things you look at. So if you think about retrospective on here, we talked about, well, low to medium is typically on a retrospective. Sometimes you might do medium to high, but that's not. But obviously the first answer, A, high frequency, high severity. You want to get out of business. You don't want to be doing any type of insurance. No one will insure that type of loss in the first place, right? So, so B, low frequency, low severity losses. Well, actually, that you're going to want to retain. You're not going to want to buy insurance for low frequency, low severity. It doesn't happen that often, and when it does, it's not that expensive. So C, medium to low frequency, but high severity losses. So the key here, if you notice what they did on C and D, is they switched up. They put on the last it's high severity losses, on the bottom it's high frequency losses. Okay, so typically high severity losses, you're never going to want. That's catastrophe. That's when you buy excess or reinsurance or some. You're going to do something much higher than that. So really, that's why D is the answer. It's low to medium severity and high frequency of losses that they happen quite a bit, but they're low or medium enough that it's something that you can control. And it's not going to put you out of business. Anything that's high severity is something that's going to be probably not in the best area for you. We'll do a couple more on, we'll use this one and we'll, okay. Oops, go back one. So we'll use, let's go back on the prior question here. My mouse doesn't want to cooperate with me. Okay, let's go ahead and we'll go to the question regarding captives. Okay. So the first question, which of the following terms identifies an insurer owned by multiple parents usually from within the same industry. Hopefully that's a fairly easy one. Okay. So the challenge here, when you look at it, is you're going to probably go between B and C. That's probably where people are struggling with, right? And so the challenge that we have on there is, so it's actually on this one, the answer is it's going to be C. It's going to be a group captive, which identifies insurer-owned. Okay, and the key word here, the difference is it's insurer-owned instead of association-owned. Okay, by multiple parents. And now you could also say, because you remember, there's agency captive and group captive, so that would be probably part of it. So I'll read actually I'll go find the text here for this one. It'll be on, so that way you can actually see the wording of what's in here. Okay, so in this case, on question 1, C is the answer. A is not correct. Rent-a-captives are arranged, designed as allow an organization to rent its capital from a rent-a-captive, which obviously made sense because of the name, right? B is not correct. An association captive is a group captive that has it sponsored the association it represents. D is not correct. A captive insurance company is a subsidiary formed to insure the risk of its parents and its affiliates on that one. So, so the captive insurance company, it's kind of different the way they describe that. So I already showed the answer to the next one, but we'll still go to that one too. So number 2, the global insurance company, Global, is located in Bermuda. It insures the environmental risks of 5 oil shipping companies. Global is an example of a, so in this one actually it's also going to be a group captive. It's located in Bermuda. It insures the environmental risks of 5 oil shipping companies. And again, this is where you can have difficulty between B and C. And so you kind of have to make sure you understand those. Actually, 3 is a good question. A group captive that requires licensure in only one state is it A, risk retention group, B, rent-a-captive, C, protective cell captive, or D, foreign captive. Okay. Now, if you remember correctly, a captive, for the most part, you can't write coverage unless you're admitted. So, but there was one type of, if you remember correctly from when we talked, there's one type of captive, which is a little different name, that allows, if you get licensed in one state, you can sell in all others. Now, they probably give some more detail, but in this case, the answer is A, risk retention group. It's the law was passed, I think, in '86. But basically allows that you can only, but the things you can only write general liability coverage is the only thing you can write for the risk retention group as part of that. All right, and then we'll just do one more, just to kind of give it, and we'll do one on insurance there. Okay. Oops, I think I went a little too far here. Okay, so here's some examples, at least on, so this would be on the chapter on non-insurance contractual transfer of risk. Now remember that this is from the old textbook for the most part. There might be some similar type of questions, but you can get the idea. So in this case, my purpose of doing this is to show you the types of questions you can expect on the exam or anything else. So if we do the first one, as expressed in this agreement, the customer agrees to maintain the leased equipment in accordance with the manufacturer's recommended maintenance schedule identified in Appendix 3. Although the company retains ownership of the equipment, the company has no obligation for upkeep or repairs of the equipment. The agreement contains what kind of transfer? And if anything, it's always easier to go the process of what it is not instead of trying to figure out what it is first. So sometimes that's also a good kind of test-taking strategy. So first of all, is it a reinsurance transfer? No. Okay. Is it insurance transfer? No, there's no contract. Is it non-insurance risk financing transfer? Does it do anything about financing? No, not really. In this case, it would be a risk control transfer. What they're talking about, retains ownership, has no obligation for upkeep or repairs to the equipment. What they're saying is they own it, but they have no responsibility to maintain, so it's more the risk of what they're actually doing for the upkeep. So that's the reason for that answer there. And the answer they actually give, this is a non-insurance risk control transfer because responsibility and exposure to maintain repair leased equipment is transferred from the leasing company to the customer. Okay, so the customer is now responsible to maintain it, so that's part of the reason there. So then you have, number 2 is a good one. The township will not provide security for the fall carnival. The facility user must arrange security in accordance with the security plan, Schedule A, and is responsible for crowd supervision and control on the fairgrounds parking lots and all adjacent areas. What kind of transfer is that one? Well, if you think there's nothing about finance, it's the same thing. It's a non-insurance risk control transfer. They're transferring all the responsibility. And when you think about why is it risk control, transfers? Because if the city was to do that, can people get injured while they're doing crowd control? Yeah, they can. They would be the ones doing it. They're transferring the control of that to the other one. So any type of injuries that are associated because they're transferring to the other party, they're the ones that are going to have to, deal with that. So that's why it's a risk control transfer. See if we can find another. You can see a question that talks about indemnification. What type of form? If you remember correctly, we had limited form, broad form, exclusive form. Which actually wasn't part of that, so that's a red herring. So you either had limited, intermediate, or broad form would be theirs. But you can kind of go through it. So this is, again, the main reason I just want to, for when you look at the types of questions, this gives you an idea of what you might expect on it and what, how you might want to study for that. So with that, that concludes tonight's class. If there's questions, by all means, certainly go ahead and type those in, or I'll unmute your line and we'll go through those. But if there's none, feel free to go ahead and email me, and I'll see what I can do to answer those as quickly as possible. And we'll go ahead and get all the information out to you regarding the exam. So again, thank you for everyone for your participation, those that attended all of the live courses and those that are listening online. Good luck on the exams, and hopefully we'll see you looking to take ERM 57 in the near future.